Hello, everyone. We're just going to wait a few more minutes for some more people to trickle in, and then we can get started on today's lesson, which I'm super excited for. This is really the part of the series where you can really learn how to save some money on your tax returns. So looking forward to that. We're just going to wait a few more minutes. All right, we have a good amount of people already here, so I'm just going to go ahead and start the lesson for today. Welcome back, everyone. Welcome to the third lesson of the Taxes 101 series. Today, we're going to be covering credits and deductions, which is a super interesting topic because this is where you can really save some money on your tax returns. So I'm very excited for today's lesson. And just some general rules. Like I've mentioned before, friendly reminder to please stay muted during the presentation unless you have a question. And all the resources that I use in this lesson and some additional resources will be available on the Google Doc resource page that will be linked in the chat as well. So those are our general rules. Here is our overview of the series so far. We're on lesson 3 today, covering credits and deductions. Since this is such a big section, it might spill a little bit into lesson 4 because there are so many credits and deductions I want to talk about. So look forward to the last lesson 2 next week on Saturday, where we're going to be wrapping up credits and deductions. We're going to be looking at the economic stimulus payments and other filing scenarios, such as like, what if I worked in different states than the one I lived in? So all very important topics. Look forward to the final lesson next Saturday. So let's just go ahead and get started with today's topics, credits and deductions. First off, what is the difference between the two? And something that people might get confused by. So let's start with that. Last time we talked about adjustments, and adjustments reduce your adjusted gross income, something that determines how much of your income is taxable. So your adjusted gross income is your gross income minus your adjustments. Now, a deduction reduces your taxable income, but does not affect your AGI. So you would be able to calculate your taxable income by taking your AGI and subtracting deductions and something else like exemptions based on the number of dependents that you've claimed on your tax return. But yes, deductions affect your taxable income. So the main difference between an adjustment and a deduction is that in an adjustment, your AGI is affected, while in a deduction, your AGI is not affected. And this can be a bit important when it comes to certain credits that I'm going to be mentioning later on today, because a lot of credits have an AGI limit cutoff. Like if you have above this amount of AGI, you're not eligible to take this credit. So in this sense, an adjustment might be more beneficial to you than a deduction, but since adjustments are pretty rare, it might be more difficult to get an adjustment than a deduction. And then finally, we have credits, which reduce the amount of tax you owe. So you could calculate your total taxes owed by taking your taxable income, multiplying that by your tax rates, and then subtracting credits from that. And that's how you figure out how much you owe in a certain year. But what you actually pay at the end of your tax return what is your total taxes owed minus any withholdings and other tax payments that you made throughout the year. And if this amount is negative, that would end up being a refund instead of you paying taxes. So all three of these very important tools to help decrease your tax dues and to get you some tax refunds. So we're going to go ahead and look at deductions. And deductions can be grouped into three larger areas. We have the standard deduction, the itemized deduction, and everything else. So let's start with standard and itemized. You can take either the standard deduction or the itemized deduction, but you can't take both. It's a one or the other kind of deal, no double dipping in your deductions. So a standard deduction is the default deduction that almost everyone who files is eligible for. There are some certain exceptions that we can talk about after this. And so standard deductions are just much easier than itemized deductions because the deduction amount is set in stone. It's calculated based on your filing status, age, and blindness. So let me just share my screen. Here's the standard deduction chart. So for most people, if you are under the age of 65 and you are not blind, based on your filing status, if you're single, your standard deduction is $12,550. Married filing joint or qualifying widower, $25,100. And head of household, $18,800. And I say if you're not blind and if you're under the age of 65, because here we can see that the standard deduction is increased for people who are older than 65 and or blind. You can see for this chart, you would check a box for any of these that apply to you. And based on how many boxes you have checked, your standard deduction would increase by around $1,000 for each checked box. So that's interesting. And then going back to this page, we can look at a few people who are not eligible for the standard deduction, which means you would have to do itemized instead. So these people would be if your filing status is married filing separately, but your spouse decides to itemize deductions, well, then you're stuck with itemized deductions as well. So, or if you're filing as a non-resident or a dual status alien during the year, you cannot take the standard deduction. Or if you're a non-resident alien who is married to a US citizen or resident alien, you can choose to be treated as a US resident. And then if you make this choice, you can take the standard deduction. But if you do not, you would have to do itemized. So that's standard deduction. Let's go back to my slideshow. Now, if you decide you don't want to do the standard deduction, the other option is itemized deductions. And this deduction is based on combining various qualified expenses throughout the year. And you would only do itemized deductions if it turns out to be greater than your standard deduction. Because how itemized deductions work is there's this whole list of qualified expenses, including but not limited to medical, dental expenses, home mortgage, interest paid, gifts to charity, gambling losses, etc. And you add up all of those expenses, and that all of that combined would be your deduction. But for most people, those expenses combined are not greater than their standard deduction, which is why they choose to do the standard deduction instead. The standard deduction is also much easier because the itemized deduction requires so much more work and accounting. Let me screen share the form for an itemized deduction, and then you can probably see what I mean by it gets really tedious and difficult. So here's Schedule A, which is the form you use if you decide to itemize deductions. You can see that it is very long, and through each of these rows, you have to enter some sort of expense that you have kept track of throughout the entire year. So that's a hurdle in itself, keeping track of these expenses for an entire year. Definitely something That's pretty difficult to do. And I feel like that's why most people do not itemize their deductions and choose to take the standard deduction instead. Now, hopping back to my slideshow. All right. And then before we move on, I want to point out this very interesting expense down here, which is gambling losses. So under itemized deductions, you can deduct any losses that you've incurred while gambling, but only up to the extent of your winnings. So if you won $1,000 but gambled away $5,000, you would only be able to deduct the $1,000. This is a way to prevent people from trying to cheat the tax system by just losing on purpose so they can deduct money from their taxes. Just an interesting note I would like to point out. And so I'm gonna go ahead and move on. So those are the two main deductions, the standard deduction and the itemized deduction. And here's one of those miscellaneous deductions that I've grouped in the other category, which is the charitable contributions deduction. This deduction is usually for people who itemize. So this is part of your itemized deduction. But for the 2020 tax year, the tax codes have changed so that now people who do not itemize deductions can still deduct up to $300 of charitable contributions or $600 if you're married filing jointly. So these charitable contributions would have to be made to a qualified organization, such as a religious organization like a church or your local government, or large nonprofits like Goodwill or Salvation Army. And if you keep track of your charitable contributions, you'll be able to deduct up to $300 or $600 from your taxes this year, which is very, very cool. Right. So that's pretty much it for deductions. Now we're going to move on to credits, which I personally think is even more interesting than deductions. There's only a few deductions, but there's a ton of credits out there that you can find and see if you're eligible for. And credits also fall into two larger categories. They're either a refundable credit or a non-refundable credit. So let's look at the differences between those two. A refundable credit is if you are eligible for it and the amount of credit exceeds the taxes you owe, the excess credit can be refunded entirely to you, as in you get that money back. But sometimes only a portion of a refundable credit is actually refundable. For example, an education credit we're going to be talking about later today, called the American Opportunity Credit, is only 40% refundable, and the rest is non-refundable. So what is non-refundable? A non-refundable credit means if the amount of credit exceeds the taxes you owe, the excess credit is not refunded and it just disappears. For example, if you owed $500 in taxes and you got a credit that was $1,000, if this credit happens to be a fully refundable credit, you wouldn't pay taxes and you would get refunded $500. But if this credit is non-refundable, you still wouldn't have to pay taxes, but you would not get that $500 back. So refundable credits are definitely more advantageous than non-refundable credits here, but they're both very good at helping you reduce your taxes owed. So we're gonna talk about some credits. I think personally the most relevant credit are some education credits. There are only two, the American Opportunity Credit and the Lifetime Learning Credit. So let me share my screen so that we can see a very nice comparison chart of the two. So here's the education credits. We have, let me get my laser pointer. We have the American Opportunity Credit on the side here and the Lifetime Learning Credit. So let's go ahead and look at some of the requirements for these credits and just some basic information. We're going to start with American Opportunity Credit on the left here, which the maximum credit you can get for this is $2,500 per student. But there is a AGI limit on it, or an MAGI limit on it. If you have more than $180,000 of AGI, married filing jointly, or 90,000 single head of household, then your American Opportunity credits will start phasing out at that point. Like I mentioned before, the American Opportunity credit is partially refundable. Only 40% is refundable, and the rest is non-refundable. There is a time limit on the American Opportunity Credit. It's only available for students who have not completed their first 4 years of post-secondary education before the specific tax year, meaning this is mostly targeted towards undergraduate students. And you can only claim it for 4 tax years. Once you've claimed this credit for 4 tax years, you cannot claim it again. So in order to be eligible for it, you must be a student, or you must be claiming a student as your dependent who is pursuing a program leading towards a degree or some other recognized education credential at a credible college or university. So you must be enrolled at least half-time for at least 1 academic period. You must not have any felony drug convictions. And then the rest are the amount of your credit is then based on some qualified educational expenses, such as tuition, required enrollment fees, and other course materials. And I'll talk about this section in more detail later, but that's just an overview of the American Opportunity Credit. Let's go ahead and look at the Lifetime Learning Credit, which is very similar to the American Opportunity Credit, but slightly less advantageous to youth. The American Opportunity Credit is definitely better, but the Lifetime Learning Credit also has its perks. So it does have less credit per return. You can only have up to $2,000 of credit per return, unlike the American Opportunity Credit, where you can get 2,500 credits per student instead of per return. The AGI limits on both are the same though, so they start phasing out at the same AGI. And the Lifetime Learning Credit is completely non-refundable, so unlike the American Opportunity Credit, which is at least 40% refundable. But where the Lifetime Learning Credit exceeds the American Opportunity Credit is that there is no time limit on the Lifetime Learning Credit. You can claim this whenever you want, as long as you meet certain eligibility requirements below. So it's available all years post-secondary education, available for unlimited amounts of tax years, but you do have to be a student that's at least working towards some sort of improvement in yourself, learning a skill maybe, so or acquiring a specific job skill you want to do. So you don't have to necessarily be pursuing a degree or some other education credential, but you do have to be at least taking some classes and improving yourself. So it is available as long as you're taking 1 or more courses. You can have a felony drug conviction and still take this credit. So this credit does not care if you have a felony drug conviction or not. And it has the Lifetime Learning Credit has the same qualified expenses as the American Opportunity Credit. Now that we've kind of talked about the two, let's dive a little bit deeper into the qualified expenses. What exactly are qualified educational expenses? So here's a short overview of some things that count as educational expenses and some things that are not qualified educational experiences. So things that are qualified are tuition and fees that are required for enrolling at this eligible educational institution, or any course-related expenses such as fees, books, and supplies that are required for the course. Things that do not count towards qualified educational expenses are your room and board, any research costs, travel costs, or any other equipment and expenses that are not specifically required at your institution. So where can you find these expenses? Fortunately, there is a very handy form known as a 1098T, which is your tuition statement. You'll be able to find how much you've paid in tuition here in box 1, so payments received for qualified tuition and other related expenses. And this related expenses refers to any other required fees for enrolling at the institution. For example, that might be a gym membership fee or a student wellness fee. And then the second most important box here is box 5, scholarships or grants. If you receive any scholarships or grants, that specific amount will show up on box 5 of your 1098T. And scholarships and grants also affect your educational expense or your qualified educational expenses. So if we go back a little to the previous page, we can see this called tax treatment of scholarship and fellowship payments, which outlines like if your scholarship or fellowship is tax-free. And then we scroll down and see the scholarship and fellowship income. And basically what your scholarship or fellowship or grant does to your qualified educational expenses is it decreases it. So this person, let's see, Chandler Washington. This is a mock 1098T. Chandler Washington is not a real person, but he paid around $5,000 in qualified tuition and related expenses. But to calculate his qualified educational expenses, we have to take this amount and subtract scholarships and grants from that. So your scholarships and grants will decrease your qualified educational expenses. Now I can scroll down a little bit more on this page and we'll see that there's another form of accounting here from the college itself, just called a statement of account. It is basically the same as a 1098T, but a little less formal. It's not an actual form, but from this you can still see the same amount of tuition paid, the scholarship, but you'll also see additional expenses here, such as a parking pass and the campus bookstore charge for course-related books. Again, remember that qualified educational expenses don't just cover tuition and fees, but they also cover required materials for classes. So Chandler could also add $450 towards his qualified educational expenses. So his total qualified educational expenses would be his tuition, around $5,000, minus the $2,000 of scholarships he has, plus the $450 of required books. Now, the parking pass does not count as a qualified educational expense because it's not required for him to attend the university. Parking pass is more of an optional thing. He can choose to bring his car or he cannot. So that does not count towards qualified educational expenses. But figuring out what is qualified educational expenses and what is not can be a little difficult. So I have a practice problem for us to do together. Oh, but before that, I should probably talk about the quantity of American Opportunity Credits and Lifetime Learning Credits that we can get. So The amount of credit for the American Opportunity Credit is 100% of the first $2,000 of qualified expenses, and then 25% of the next $2,000 of qualified educational expenses. If you remember, the limit on the American Opportunity Credit is $2,500. So you would need at least $4,000 in qualified education expenses to receive the full credit. Then going down to the lifetime learning credit, the amount here is a bit more straightforward. It is just 20% of the first $10,000 of qualified education expenses. So you would get for a maximum of $2,000 per return. So you would need at least $10,000 in qualified education expenses to receive the full lifetime learning credit. Just a little bit of information on both if you wanted to think about if you would be able to receive these credits this year, thinking about how much qualified educational expenses you have. So now we can go ahead and try a practice problem, I think. Here we go. Yes. So in the list below, what counts as a qualified educational expense for the purpose of an education credit? I'm going to give you guys like 3 minutes to try this out on your own. And the chart that I was referencing earlier is in the Google Docs if you want to reference that. All right. I hope everyone had a chance to give that a try. I realize now that I may have accidentally put the answer to the last one on the slide, but whoops, that's a typo. So let's go over the answers now. So out of the 8 things that I've listed on the slide, 4 of them count as a qualified educational expense. And the 5th one is like a maybe. So we said tuition is a qualified expense, The cost of a textbook that's required for a class also counts. Required fees to enroll in the institution counts. And this one might have tripped people up a little. The cost of required safety goggles for a chemistry lab. Again, a required piece of equipment for a specific course, so that would count. And the last one is a maybe, because this depends on if your institution requires protective masks on campus. If that is a requirement, then yes, you could deduct the costs of buying protective masks as a qualified educational expense. Now, the things that are not qualified educational expenses are the parking pass fee, which we mentioned earlier, because that is optional. So is the badminton club fee and the cost of an iPad and Apple Pencil. Some people may argue that they need this because that's how they take notes in class, but it's not required for the class. So it's technically not a qualified educational expense. You could do just as well with pencil and paper. So if it's not required for the class, like a textbook or safety equipment for a lab or something, it is not a qualified educational expense. So that's the educational expenses side of the education credits. But now let's dive a little bit deeper into who specifically can claim this credit, because it can get a little tricky. That's not it. Whoops. Here we go. Continue. Who can claim this credit? There's obviously the student who is attending the institution, but there's also the parent who is most likely the one funding the cost of attending this institution. So let's look a little bit more into this. Whoops. Who can claim this credit? Taxpayers who paid qualified educational expenses for higher education for an eligible student, unless they're married filing separately. So this means if you are the student and your parents claim you as their dependent, your parents would be able to claim this credit. Second bullet point is taxpayers who paid the education expense for a student or enrolled or attending an eligible education institution, which is basically the same as the first bullet point. Again, the example I used earlier, if your parents claim you as a dependent and they pay for your expenses, they can claim the credit. So the eligible student could be either the taxpayer, like your parents, or their dependent, which would be you. But there is this fun little note here that says, if the qualified education expenses are considered paid by their taxpayer, are considered paid by the taxpayer, if paid by their dependent or a third party on behalf of the dependent, and if the student isn't claimed as a dependent, even if they can be claimed. So if you could be claimed as your parents' dependent, but your parents decided not to claim you, then only the student, or that'd be you, can claim this education credit, no matter who paid the expenses. So your parents could have paid the entire cost of your tuition, but if they decide not to claim you as the dependent, you would be the only one who's able to claim the education credit, even though you paid no expenses by your own. So anyone paying the expenses that's not yourself would have been considered to give you a gift. So it'd be like a gift to you. You did not pay for it, but you can still claim the credit for it. Very interesting. So here's a little chart. Who can claim a dependent's expenses? This would be, for example, if you were the one paying your tuition. So if the taxpayer has a dependent who's an eligible student, for example, your parents, then only the taxpayer can claim the credit based on the dependent's expenses. The dependent can't claim the credit. So even if you are the student and you paid the entire cost of your tuition, if your parents can claim you as their dependent, your parents are the one who can claim this credit, not you. But if your parents do not claim you on their tax return, then only you can claim your credit. And it doesn't matter if your parents paid the entire cost of your tuition or not, only you are allowed to claim that credit. So it really depends on your dependency status. If you can be claimed by someone else, you most likely will not be able to use this credit. But if no one claims you, then this credit is entirely yours. So again, a few exceptions to people who can claim this credit. So some people who cannot claim this credit are married filing separately. If you file as married filing separately, again, anyone who is a dependent, taxpayers whose modified AGI is above the limits, or if the taxpayer or the spouse was a non-resident alien for any part of the tax year. But then again, there are also exceptions to that if you want to look more deeply into that. So now that we've got a good idea of who can claim this credit, is it the dependent? Is it the taxpayer who might be your parent? Let's do a practice problem on education credits. Oops. So here's a scenario. We have Jenny, who is 20 years old and is a dependent of Sarah and Connor. Sarah and Connor are married filing jointly this year and have claimed Jenny as their dependent. Their modified AGI is $120,000. Jenny is a full-time undergraduate student at Duke University and is expecting to graduate in May 2023 with a BS in economics. Jenny has never had a felony drug conviction, and Jenny has received a 1098-T from Duke with $86,000 in box 1, which is for qualified tuition and related expenses, and $70,000 in box 5, which is scholarships and grants. So with this information, is anyone among Jenny, Sarah, and Connor eligible for the American Opportunity Credit? And if so, who can claim the credit? After that question, how much American Opportunity Credit can be claimed? So I'm going to give you guys around 5 minutes to try working this out on your own. This is a bit tricky, but I think the resources that are available on the Google Docs will help you work through it. So good luck. We'll come back in around 5 minutes. Alrighty, I hope everyone tried out this scenario. We're going to go ahead and go over it together now. I am going to be switching my screen to the chart we were looking at earlier. So if you want to take a screenshot or a picture of the slide so you have the scenario, feel free to do that now. And I'm going to be switching my screen now. All right, so first, let's, where is it? There you go. First, let's figure out if any of them are eligible for the American Opportunity Credit. So, or sorry, we should probably start off with the easier one first, which is who can claim the credit? Like we mentioned before, if you can be claimed as a dependent, you are not eligible to claim the credit. So in this case, only Sarah and Connor can claim the credit, but we'll have to see if they're eligible or not for the credit, depending on Jenny's educational status. So we saw in the scenario that Sarah and Connor are married filing jointly. So there is one thing out of the way. They're not married filing separately. If they were, they would not be eligible for the credit. And then we see that they've claimed Jenny as their dependent. So Jenny be the one who can make them eligible for the American Opportunity Credit. The scenario also says that Sarah and Connor's modified AGI is $120,000, which is under the limit for married filing jointly of $180,000. So they're good on that requirement. They're not over the limit. Let's see. And now for more of Jenny's. So Jenny is a full-time undergraduate student, which suggests that she has not completed the first 4 years of post-secondary education. And because of that, she has not claimed, or the American Opportunity Credit has not been claimed for her 4 times yet, because she has not graduated or gotten any sort of undergraduate degree yet. So these 2 requirements are out of the way. You see the next one, the student must be pursuing a program leading to a degree. We saw that in the scenario. We were told that Jenny is expecting to graduate in May 2023 with a BS in economics. So she is definitely pursuing a degree, and she is enrolled full-time. So that gets rid of the number of courses requirement. She has not been convicted of a felony drug has not been convicted of a felony for possessing or distributing a controlled substance. So that requirement is also out of the way. So that would be all of them for the requirements. So in this case, yes, Sarah and Connor are the ones who are eligible to take the American Opportunity Credit. Okay, but now how much American Opportunity Credit can Sarah and Connor get? Like we said earlier, it depends on their qualified educational expenses. And in this case, we're only told of 2 parts of Jenny's 1098T. So there's the answer to the first question. We're told that her 1098T has $86,000 in box 1 and $70,000 in box 5, and she has basically no other qualified expenses listed. So remember again that to calculate qualified expenses, you have to take tuition, fees, and other required materials and subtract scholarships and grants from that. So Jenny's total qualified expenses would be $86,000 minus $70,000 for a total of $16,000 of qualified expenses. But then we have to think about how much of the credit can Sarah and Connor claim on her behalf? And the limit for the American Opportunity Credit is $2,500. And what we saw in the previous slides about the benefits were that you need at least $4,000 to receive the full credit. Or sorry, you need at least $4,000 in qualified educational expenses to receive the full American Opportunity Credit. And since Jenny has $16,000 of qualified educational expenses, we can confidently say that Sarah and Connor will be able to claim the full credit. So they'll be able to claim the entire $2,500. Does anyone have any questions about these scenarios or the education credits before we move on to a different credit?
Yeah, I do, Ellen. So,
Yes.
I understand. Which resource in the Google file shows the breakdown for the expenses? I remember that like up to a certain point you get up to a certain amount you get 100%, and then after that I think it's 20%, but I don't remember what those numbers are or where they are.
Yes, so that is not, I think, directly linked on the Google Docs. There is like a broader IRS guide that has it, but you can also find that on my slides for today. I don't think I have them posted yet, but they will be after this presentation.
Okie doke.
Yes. Any other questions? If not, let's move on to another pretty relevant tax credit, but mainly for people with children. So it is called the child tax credit. And this year specifically, it is completely refundable. So a very nice credit right there. Let me share my screen again so that we can take a look at the requirements for the child tax credit. Where is it? Here it is. So the refundable child tax credit. As we can see in this little note at the top, the American Rescue Plan Act of 2021 has expanded the child tax credit for the tax year of 2021 only. And this expansion means that the amount of credit has increased. For eligible taxpayers, the credit is now fully refundable. There has been some changes to the age requirement and additional changes to advance payments for the credit that we won't talk about in this session, but they are linked in the resources doc. Now, there is one exception to the child tax credit. If you have lived in the United States for more than half of 2021, or if you're a resident of Puerto Rico for 2001, the child tax credit remaining after the limitation is still fully refundable. So that's one exception that has been made for people who are not a US residents. So that is very nice. And now let's look more about the specific numbers for the child tax credit. So down here, we can see families who claim this will receive up to $3,000 per qualifying child between the ages of 6 and 17. And they will receive $3,600 for qualifying children under the age of 6. So there is a little separation here. You will get more credit if you have younger children. And in the next little paragraph, we have the phase out limits. So for incomes over a certain amount. And then finally, we have the definition of a qualifying child. So who could be a qualifying child for you if you want to take this credit? First, they must be under the age of 18, which makes sense because if you want the credit, your children have to be either between the age of 6 or 7 or under the age, 6 or 17 or under the age of 6. So they do need to be under the age of 18. Your qualifying child must be a US citizen or a US national resident alien of the United States. Your child must also be your dependent. So the next couple of bullet points are all talking about what it means to be a dependent. So they must be related to you in some way as your child or as your sibling. They must not have provided more than or over half of their own support. They must have lived with you for more than half the year, except for temporary absences, which again include things like living on campus if you're a full-time college student, or if your child went to a boarding school. That would count as temporary absences and would not factor into the living with you for more than half of the tax year requirement. And then lastly, your child must have a social security number that is valid. So if all of these things apply, then you have a qualifying child that you can use to claim their tax credit. So this is a very helpful chart, and it is available on the resources doc. I say that because now we're going to do a practice problem for the child tax credit really quickly because we don't have that much time left, which is my bad. But here is another scenario. We have Sophia and her 3 children. You can go ahead and read that on your own, but the main question is, how much child tax credit can Sophia claim? I'll give you guys around like 2 to 3 minutes to try and figure that out. Alrighty, I hope you guys at least had the chance to take a crack at this. We're gonna go ahead and go over it now for the sake of time. So let me just go ahead and show the answers, which is $6,600. Now, how is this calculated? So Sophia's children meets all the requirements to be Sophia's dependents, as we can see here, because she does claim them as her dependent. Her AGI is below the limit. They all have social security numbers, are US citizens, so they meet most of the requirements. Now, the big difference here is their ages. So Sophia cannot claim the child tax credit for James because he is over the age of 18. He is 19 years old. So no tax credit from James, but Hope is 14 years old and meets all the other requirements to be a qualifying child. So Hope falls in the 6 to 17-year-old bracket, which means that Sophia can claim $3,000 from Hope. And then Ella, which is 3 years old and meets all the qualifications to be a qualifying child, is in the under 6 years old bracket. So she can get $3,600 from Ella and add it all together for a total of up to $6,600 of child tax credit for Sophia. Does anyone have any questions on that before we move on? Right. So the last credit we're going to talk about today is the earned income credit. Now, this credit is targeted towards more low to mid-income families with children. I can go ahead and quickly share my screen and show you the chart here. So if we look down at the AGI limits, we can see that this is mainly for people of lower to mid income with children to support them and to give them tax breaks. So it may not apply to everyone here, but and for the sake of time, I'm not going to go over this table in much detail, but you can take a read through it if you want. And I think I just have a few more slides left. The last one is this really handy chart of the earned income credit benefits. So we can see here that it's divided based on how many children you have. So 1 child, 2 childs, no 3 childs, no children at all. And we can see how much credit you'll be able to get based on the number of children. We can see the highest amount is $6,700 around of the earned income credit based on having 3 children and having a gross income around $14,000 to $20,000. So this is a very interesting chart. This shows how the phase outs of this credit works. And it has the shape to encourage low income people to work a little bit more, or if they have children, to be able to support their child more by working. So interesting shape there. If you want to learn more about that, highly recommend the resources in the resource docs. And that would be all for me today. Sorry, I ran just a minute late, but thank you all for coming this week. And I'm so excited for the final session next week, where we're going to be wrapping up some credits that I did not get to today. We're going to be talking about the stimulus check and how you might be able to claim that check if you did not receive it and are eligible for it from filing your taxes. And then some other scenarios, such as if you worked in a different state than the one you lived in, how would your state return be affected? And just wrapping up the return in general, how to get a refund, how it will be paid, how long it will take, some general information like that. So look forward to that last session, and thank you all for coming. See you next week.
Thank you, Anna.